Hi, I'm Jacob Schmidt. I'm one of the financial advisors here at Financial Planning Services. Around this time of the year, we usually like to have an educational workshop for our clients and their guests, but because of the scenario we're dealing with now, it doesn't make sense to meet in person, so instead we're replacing that content with a video webinar instead. So welcome to our investor update. Today's agenda is straightforward. First, I'll share a brief investor update, and then I'll discuss some planning ideas and strategies that you can consider. So before I get into the presentation, I'd like to take a minute to remind you to stay safe and stay positive. We're all experiencing challenging and unprecedented times, but Ralph Waldo Emerson said many years ago, the first wealth is health. So before I begin, I find it's always important to review that there are 6 key areas of financial planning. They include retirement planning, investment planning, tax planning, estate planning, long-term illness planning, and survivor planning. And even though today's presentation is primarily about the equity markets, as a comprehensive wealth management firm, we try to always consider the impact of our recommendations that we make for clients on all of these areas. So what if I told you last year that a global recession was coming, the US might start a recession as well, there was going to be a trade war with China, the president would get impeached, and the Middle East would fire rockets at US military bases? With all that information, would you have expected the stock market to go up? Well, that's exactly what happened. And despite all of those concerns, 2019 was a healthy year for investors, and even 2020 started out on a strong note. Then, in mid-February, after making new all-time highs, things changed quickly. A silent and deadly virus quickly decimated an 11-year bull market. After a strong year that was not foreseen in 2019, in less than 3 weeks, the S&P 500 went from a 52-week high to a 52-week low. And this quick waterfall of the equity markets has set many records. And we'll talk about a few of those. Although most experts predicted a reasonable year for 2020, we are now in an unexpected period where it seems as if the economic outlook is evolving daily. So knowledge is power, and we believe that an educated client is our best client. So let's examine some data and some facts today. After an 11-year bull market, we are officially in a bear market. A bear market is defined as when a market falls at least 20% or more from its 52-week high. Bear markets, the most basic principle is that bear markets are a part of the investing experience. If you invest in the long term, you will experience bear markets. So since entering the bear market as of early April, a bounce back of equity markets has existed. That may have ended this bear market officially, but we're still in very volatile times and we are still down from our all-time highs. Since we're discussing bear markets, which again is a close to 20% down, it might be helpful to review some information about bear markets. They come in 3 different categories: structural, cyclical, and event-driven. So a structural bear market are those created by imbalances, financial bubbles, often followed by price shocks like deflation. So this is what happened in 1929 and again in 2008 when the financial system was in trouble. Cyclical bear markets are typically a function of the economic cycle, marked by rising interest rates, impending recession, falls in profits, things like that. But the scenario we're dealing with right now is an event-driven bear market. So this is going to be similar to an event like war, oil price shock, an emerging markets crisis, or in our case, a viral pandemic. After lowering the federal funds rate by ½ point to a range of 1 to 1.25%, in its regular scheduled meetings, response to the COVID-19 coronavirus outbreak created a need for the Federal Reserve to cut their benchmark interest rate even more. So in mid-March, they cut it by a full 1% down to next to nothing, 0 to 0.25% range. When the Fed first started reducing interest rates, many experts noted that the central bank was just catching up to where markets had headed. But now it seems as if they're responding to both the economy and the fact that the 10-year Treasury had fallen off to all-time lows. The all-time low for the federal funds rate is effectively 0. And the Fed has only lowered their rate to this range twice. Once during the financial crisis of 2008, which you can see here, and once right now, March 2020. Another item that we're dealing with is that the US government is responding by trying to prevent the threat of a recession and attempting to help businesses. So they have passed several bills. The one you hear about all the time is the $2.2 trillion CARES Act, which stands for Coronavirus Aid, Relief, and Economic Security Act. This emergency relief package is the largest economic relief package in U.S. history. Now, as if things weren't bad enough, the oil price war between Saudi Arabia and Russia emerged suddenly and dramatically on March 7th, which decimated the energy industry. Oil prices saw the worst month and quarter in oil price history, down over 50%, with energy companies and oil still being a contributing factor to the overall economy. So oil prices have added to the equity market's problems. Remember that in all this volatility, a bad decision could be very harmful. So as this chart shares, the 6 biggest point declines and the 6 biggest point increases in the Dow Jones Industrial Average all came in the last 5 weeks of the first quarter of this year. So on March 12th, the Dow Jones fell 2,300 points, which was over 9%. And had you sold on that day, you would have missed the very next day of the market, which was a rise of 1,900 points, so also a move of over 9%. So the level of volatility that we're dealing with right now is unprecedented, and therefore even the savviest investors need to proceed with caution. The volatility and turbulence of this current economic and political environment has caused even some of the most seasoned investors to become skittish. And in March, legendary investor Warren Buffett said that he hadn't seen anything like the coronavirus pandemic in the past. Some of the research out there shows that even in Warren Buffett's portfolio, some of his average stocks in the top holdings on March 24th were still down 37% from their highs in February. So the most important thing to remember is that, like everybody, even Buffett's portfolio hasn't been immune to this volatility. This is a good time to recall one of his most famous quotes, which is, "The stock market is a device for transferring money from the impatient to the patient. We strive to teach patience with all of our clients, teach you to avoid bad behavioral decisions." So how should an investor approach the rest of 2020? We advocate being prepared and not scared. So how to move forward? One of our responsibilities is to look at all your situations, guide our clients with ideas, and even a treacherous downfall has some opportunities. So let's review some of these opportunities. First, think long term. It's still the way to go when thinking about equity investments. Typically, the most successful investors think and act for the long term. It's nearly impossible to predict exact market movements. However, you can prepare. While no one likes losses from a tax standpoint, they can be helpful. I'm not going to go too much into tax swaps and banking losses, but the bottom line is if you have non-retirement accounts and you have experiences some decrease in the values of those accounts, it may be a good idea to talk to us, talk to a tax preparer. There are some complicated items that go along with that, like the wash sale rule, but if this is a strategy you want to discuss, please call our office. Maintaining a properly designed and well-diversified portfolio is very, very important. This is one of the key things that we do for our clients. Now is a good time to look at your portfolio and consider any rebalancing that may need to be performed. For many investors who had a 60-40% stock to bond portfolio a few weeks ago, this percentage may have changed in the last few weeks, last few days potentially. But for some investors, this could include selling things that have risen in value and buying things that have fallen in value. And this can be a good opportunity to invest at potentially lower prices. Another strategy and idea, the required minimum distribution for 2020 on some or most retirement accounts has been waived. So some investors may not need to take distributions from their retirement accounts at this time. If you're comfortable with suspending distributions and looking for a potentially better time to take them, please call our office. We can see if this strategy works for your personal situation. And then another strategy that we talk to our clients about all the time is Roth conversions. So they can be complicated, so there are many reasons to consider them as well, though. So some of those reasons include tax brackets. Depending on who wins the presidential election this year or how much the government injects into their stimulus, there's a chance for some investors that tax brackets may rise. So for retirement accounts with stocks, account values may be down now. It could create some opportunities, especially for those investors currently in the 12, 22, 24% tax brackets. And another reason to think about the pros and cons of a Roth conversion is that the new Secure Act changed what happens to inherited IRAs. So as a reminder, in December of last year, a major piece of legislation came out known as the Secure Act. signed into law at that point, and this new act brings massive changes for those of us with retirement savings. I'm not going to review the entire Secure Act today, but it does have a 10-year rule that now says that most inheritors of retirement accounts can no longer stretch out their inherited IRAs. They now need to plan to take it all out within 10 years of the date of death of inheritance. So this means that we should review your retirement plan sometime this year. Look into what we are calling family tax bracket management for you and your beneficiaries. So give us a call about some of those ideas. Speaking of taxes, the deadline for filing 2019 taxes has officially been pushed back to July 15th of 2020. This deadline also makes IRA and HSA contributions. That deadline has also moved to that same July 15th date. So deadlines for these contributions to workplace savings plans have not changed. So those are your workplace savings plans. Those have not changed. But please check with your state for any changes to state filing deadlines. If you want to make contributions, it may take an extension of your tax filing, your tax filing for this year. But again, call us, call your tax preparer. We can walk through some of those items with you. In summary of some of the things we've talked about today, equity market volatility is back, and we know it can be scary. And that's why we always say to proceed with caution. This is a very important slide, very important content to know. Fear sells. Everywhere you look, there's media magnification of the current financial crisis. It's putting a major emotional strain on many viewers. So during these times, it's prudent to resist the temptation to watch news reports and obsessively watch your portfolio performance. It's prudent to resist the temptation to watch news reports. Sometimes the more information you have, the more likely you could make a decision that deviates from your long-term strategy. Adhering to a long-term investment plan often requires taking the news with a grain of salt, putting the impromptu advice of others on the back burner. Remember, I'm going to repeat this. Panic and bad decisions can cause more harm for investors than a virus or market downturn. Again, panic and bad choices can cause more harm for investors than any virus or market downturn. So some of the key takeaways from today: 2019 produced some strong returns for stock investors. Same thing for the beginning of 2020, but extreme volatility has reemerged. Your health is our first priority. But if your other priorities and goals, they're still important too. So continue to focus on your personal goals and call us with any concerns. What can you expect from us? You can expect regular communication, more frequent discussions like we're doing right now, and you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. So I wanted to thank you for your time today. Remember, your health and well-being is our highest priority. We appreciate the opportunity to assist you with your financial needs. As always, if you have a friend, a family, a coworker who needs this information or just needs some questions answered or some concerns calmed, feel free to have them give us a call or share their information with us. We'd be happy to provide some information in a newsletter form to them. But again, thank you so much for your time. Please stay safe and healthy, and give us a call with any concerns. We are here to help. Have a great day.